Bloomberg has learned that Fed officials are stepping up scrutiny of the biggest U.S. banks, including J.P. Morgan, Goldman Sachs, and Morgan Stanley. What they're looking at here is capital levels. For more on this story, we're joined by Bill Cohan, former investment banker, author of The House of Cards, and a Bloomberg contributing editor. Bill, glad to have you back. We say capital levels. What they're really looking at here is capital for the sake of making sure these banks are able to withstand a turnaround, a potential turnaround in financial markets, because we've got all this talk of asset bubbles lately. What are the implications here from your perspective?
Well, first of all, it wasn't that long ago that we were really concerned about these things, and it really made a difference. So it's a good thing, I think, that they are focused on this. Now, I don't think it's any coincidence that at the same time that the Fed is looking to have higher capital levels at these firms, you know, people like Congressman Ron Paul are looking at the Fed to increase the scrutiny of the Fed. So it might be an interesting parallel construction that these two things are happening at the same time. But as far as investors are concerned, I think, by and large, it's a good thing. You want to have as much capital in these firms as you possibly can to withstand, you know, asset write-downs. If we're going to have another asset bubble, if Lord knows, I hope we don't, but it seems like we might be building towards one again, then if there's going to be write-downs, they've got to be able to withstand that, and investors need some protection.
No question the Fed is under a tremendous amount of political pressure, not just from Ron Paul, but from Chris Dodd, for example. Is what we're seeing here, though, the Fed going ahead and becoming effectively the systemic risk regulator without a congressional mandate to do so?
Well, I think that, you know, probably they can read the tea leaves as well as anyone. But let's face it, these firms, because there's no securities firms anymore regulated by the SEC by and large, these big firms are now regulated by the Fed. And the Fed is doing its job, theoretically, or it's trying to do its job, which is what it should do. So I have no problem with this. And if it turns out that they, at the end of the day, are the systemic regulator, well, then they're that far ahead up the learning curve.
How much of a concern should this be for bank investors on two levels? The one being, of course, the more capital a bank has to hold, the more it's going to depress return on equity. But secondly, there's a lot of pressure right now to pay big bonuses. People don't really know what the new capital regime is going to be like. Should these banks be handing out this much money in bonuses when they may have to harvest some of that capital and some of that revenue to build capital as early as next year?
Well, I mean, I'm sure they feel that they're trying to balance two things. One, you know, rewarding people for a good job, not wanting them to leave to go to rival firms and or hedge funds, at the same time as making sure they have enough capital to meet the new regulations. I'm sure to some extent in this market, they probably feel that they can go into the market and raise the capital if they need it. I thought it was an interesting new little twist that some investors at Goldman Sachs are suggesting that they not pay these big bonuses and return that money to shareholders to whom it belongs. That's a very interesting concept.
It is an interesting concept, and I don't want to be unfair to the Wall Street Journal, but I read that story too, and they don't name any of these big investors who apparently have urged Goldman Sachs to pay smaller bonuses than they might otherwise be inclined to.
Well, okay, you know, name or no name, I do think it is an interesting idea. The money does belong to shareholders, right? And if you're paying out these huge bonuses that could otherwise be going to shareholders, well, that's something to think about. How much is too much? Forget, you know, too big to fail. How big are too big? The bonus is too big at some point to make sense to shareholders, to the economy at large, to people beyond Wall Street and in Main Street.
But how do Goldman's shareholders benefit, for example, if Goldman pays smaller bonuses? If everybody else isn't doing the same thing, it puts Goldman at a potential disadvantage. That's not good for shareholders.
Well, there's the balancing act, but the money does belong to shareholders, Eric. And, you know, do you need to pay out $20 billion in bonuses to retain these guys? I don't know I don't know the answer, but some of that money should go back to shareholders. It's an interesting idea.
Are you implying here that perhaps shareholders should have a say in how the money gets doled out?
You mean suggesting that it's their company, Eric? Well, I mean, I guess they've hired Lloyd Blankfein and the board to manage that for them. That's the nature.
They seem pretty satisfied, judging from the share price.
That's true. Things have recovered nicely. Thanks, by the way, to the $12 trillion infusion that people like Goldman Sachs and other firms got from
other firms, too. Other firms aren't doing nearly as well as Goldman, and they've had even more assistance than Goldman has. I'm not rushing to Goldman Sachs' defense here. I just think it's important to
There's no
to show
question
everybody
that Goldman Sachs is best in show. And they are able to make money from money better than anyone else on the planet. And their employees should be rewarded, and their shareholders should be rewarded for that.
It remains a controversial topic. Always great to
Yes.
talk to you about it, Bill. Thanks very
Thank
much
you,
for
Erik.
being here this morning. That's Bill Cohan, author of The House of Cards, former investment banker at J.P. Morgan, Merrill Lynch, and Lazard, and a Bloomberg contributor.